So 5 years ago, I started my first incorporated business in Canada, and I had absolutely no idea what I was doing when it came to taxes. I knew I needed to incorporate. Everyone told me that. So I did. I got my articles of incorporation, opened a business bank account, filed with Corporations Canada, and started making money. But then came tax season. I was paying myself a salary because that's what I thought you were supposed to do. I was maxing out my RSP because that's what the internet told me. And I was leaving the rest sitting in my corporation because I didn't know what else to do with it. And every single year, I watched a massive chunk of what I worked so hard to build just disappear to CRA. First at the corporate level, then again when I tried to take the money out personally. I remember sitting with my accountant asking like, hey, is there anything else I can do here? And the answer was always some version of, look, you're doing everything you can. This is just how it works in Canada. The more money you make, the more CRA takes. But here's the thing, that wasn't entirely true. There were strategies available to me, strategies written directly into the Income Tax Act that could have changed everything for me. Strategies that wealthy Canadians and sophisticated business owners had been using for decades. I just didn't know that they existed. And honestly, neither did my accountant, at least not in a way that they could actually help me implement them. So it wasn't until I started working with top elite financial professionals, the top advisors in Canada who specialize in these exact strategies for business owners, that I finally understood what I had been missing. And what I learned completely changed my approach to building wealth. So this is the education I never got. This is the complete playbook for Canadian business owners. I'm not going to give you a teaser and then try to sell you something at the end. I'm going to give you literally everything that I know now, the actual strategies, the real mechanics, the specific Income Tax Act sections that make this possible, all of it. So my name is Joey, co-founder for Zof Wealth Group. Over the past 5 years, I've worked alongside some of the top financial professionals in Canada, advisors who specialize in implementing these strategies for incorporated business owners, professionals, and high net worth families. I've implemented these strategies for myself, I've implemented them for the people closest to me, and I've had a front row seat watching thousands of Canadian business owners implement them through my network. Today, I'm pulling back the curtain on everything I've learned. Now, before we go any further, obviously this is educational content only. This is not personalized tax or financial advice. Your situation is unique, and you absolutely need to work with qualified professionals before implementing anything I discuss. Tax laws also vary by province and change over time, so always verify current rules with your current professional team. Cool? Let's get into it. So for the next 30 to 45 minutes, I'm going to walk you through 6 chapters, okay? Chapter 1, why there's a gap between what your accountant knows and what you actually need and why it's not their fault. Chapter 2, the Capital Dividend Account, the most powerful tax-free wealth transfer tool available to Canadian business owners. Chapter 3, the 3 major wealth building strategies, IPPs, corporate-owned life insurance, and the insured retirement plan. Chapter 4, the critical difference between tax deferred and tax-free, and why getting this wrong could cost you hundreds of thousands of dollars. Chapter 5, who these strategies are actually designed for. So I'll be completely honest about who qualifies and who doesn't. And finally, chapter 6, what to actually do with this information, okay? So you're gonna see that at the end of this video and in the description is gonna be a completely free PDF workbook that just summarizes everything that I'm sharing in this video. So if you want, you can download this right now. I'm not even asking for your name, email, phone number, nothing like that. You can just click on the button, download it, and it's yours. So just in exchange of watching this video, just download this workbook and follow along with this video. You can feel free to watch one chapter at a time, save this video and come back to it later, or just watch the whole thing in one sitting. But before we dive in, let me give you the single most important insight from this entire video right now, because I want you to get value even if you never watch another minute, okay? So look, the reason most Canadian business owners overpaying taxes isn't because they have bad accountants. It's because the strategies that could help them the most exist at the intersection of 2 different professional licenses. And the person with one license legally cannot do what the other person with the other license does. So your accountant is trained in tax compliance. They're experts in filing your tax returns accurately and maximizing deductions within the strategies they're licensed to implement. But there's an entire category of CRA-approved strategies that can potentially let you create massive deductions or transfer millions of dollars tax-free to your family, but that requires both tax expertise and insurance licensing to implement properly. And your accountant doesn't have an insurance license, and your insurance agent or your financial advisor may not deeply understand corporate tax strategy. So that's the biggest problem, right, that you might be experiencing right now. It's not anyone's fault. That's just how professional licensing works in Canada. And understanding this gap is the first step to closing it. So let me ask you a question that might make you uncomfortable. If there were legal strategies written directly in the Income Tax Act of the CRA that could allow you to transfer millions of dollars from your corporation to your family completely tax-free, why hasn't your accountant told you about them? Look, I asked myself this exact question. When I first started learning about these strategies, I thought there had to be a catch. Maybe they were too risky. Maybe they were in some gray area with CRA. Maybe they only work with billionaires. But the more I studied the Income Tax Act, the more I talked to professionals implementing these strategies every day for business owners like yourself, the more I realized these strategies are completely legitimate. They're written directly into the Canadian tax law. They've been used by sophisticated business owners for decades, and they can benefit incorporated business owners at many different income levels. So why the silence? So here's what I discovered. It's not a conspiracy. It's a licensing gap. That's it. Think about it like healthcare. A family doctor is excellent at diagnosing common problems, prescribing medication, and keeping you healthy day to day. But if you need a heart surgery, they're not going to do it themselves. Not because they're a bad doctor, but because heart surgery requires different training, different tools, and a different license. The same structural gap exists in financial services. Your accountant, your CPA, is trained in tax compliance. Their expertise is taking your financial information, maximizing deductions within the strategies they know, filing your returns accurately, and keeping you compliant with CRA. And they're typically excellent at that. And you absolutely need a good accountant in your business. But here's where the gap shows up. Some of the most powerful wealth building and wealth transfer strategies in the Income Tax Act sit at the intersection of tax law and life insurance design. Your accountant typically doesn't have an insurance license. They're not trained in how life insurance policy design affects tax treatment. They legally cannot structure insurance-based strategies. And on the other side, most insurance agents or financial advisors don't deeply understand the Income Tax Act. They can sell you a policy, but they may not understand how to structure it for optimal tax efficiency within your corporate structure. So what happens? Well, business owners end up in the no man's land. Your accountant knows taxes, but can't implement insurance-based strategies. And your insurance agent and financial advisors knows insurance, but may not understand advanced corporate tax planning. And the strategies that could help you the most remain completely invisible. So this isn't anyone's fault, okay? It's a structural gap in how professional licensing works. Now, I'm not making this up. Let me give you the actual Income Tax Act sections so you can verify this yourself or have a CPA verify, okay? So first we got the ITA Section 89.1, which defines the capital dividend account. Then we got ITA Section 83.2 that allows tax-free capital dividend payments to shareholders. Then we got ITA Section 148, which governs life insurance policy taxation. Then we got ITA Section 147.1, which are individual pension plans. We've got ITA Section 2481, which are retirement compensation arrangements. There's ITA Section 125, small business deduction rules. ITA Section 129, which are RDTOH and dividend refund rules. ITA Section 51, which are shareholder benefit rules. There's an income tax folio, S3, F2, C1, which are CRA guidance on capital dividends, right? So they're all going to be listed below. You can look them up by yourself or send this to your CPA to verify all that. But hopefully you understand by now that, look, these aren't loopholes. They're not aggressive tax shelters that CRA try to shut down. They're a fundamental part of the Canadian tax law that has been there for decades. So the question isn't whether these strategies are legitimate or not. The question is why most business owners don't know about them. Because look, I didn't know about them at all before meeting all those financial professionals that I have now. And now, hopefully you understand the answer. So in the next chapter, I'm going to introduce you to what I believe is the single most powerful tax planning tool available right now to incorporated Canadian business owners, something called the capital dividend account. And I'll explain exactly how it works. If I told you that there was a legal way to transfer millions of dollars from your corporation to your family completely tax-free, would you believe me? No dividend tax, no income tax, nothing. Most business owners don't believe it when they first hear it. But this mechanism exists. It's written under Section 89.1 of the Income Tax Act, and it's called the Capital Dividend Account, or CDA. I'm going to refer to that a lot, CDA. So the CDA might be the single most powerful tax planning tool available to incorporated Canadian business owners. And yet, most business owners I talk have never heard of it, okay? So let me explain exactly how it works in the most simplest way possible. So the capital dividend account is what's called a notional account. It's not a physical bank account. You won't see it on your bank statement. It's a tracking mechanism that keeps track of certain tax-free surpluses accumulated by Canadian-controlled private corporations, or CCPCs, okay? So here's why it matters. When your corporation accumulates credits in the CDA, in the capital dividend account, those credits can be distributed to you, the shareholder, as a tax-free capital dividend. So under Section 83(2) of the Income Tax Act, this is not tax deferred. This is not taxed at a reduced rate. This is how you can distribute yourself money completely tax-free from your corporation. So several things create CDA credits, okay? Number one, the non-taxable portion of capital gains. So 50% of your net capital gains goes into the CDA. Then there's capital dividends received from other corporations. Then there's the biggest source most business owners don't know about is life insurance and death benefits. These are all CDA credits that you can accumulate. So here's the formula. This comes directly from the Income Tax Act, so feel free to verify this on your own behalf. CDA credit from life insurance equals death benefit minus adjusted cost basis, okay? And the adjusted cost basis is calculated as your premiums paid minus your net cost of pure insurance, which is called NCPI, okay? And this is deemed mortality cost defined in the Income Tax Act under Section 148(9). And as the insured gets older, the NCPI, right, or the net cost of pure insurance accumulates, which reduces the ACB over time, so your adjusted cost basis, okay? So for many policies, especially as the insured ages, the ACB can drop significantly, sometime near to zero. And what happened then is that virtually the entire death benefit becomes a tax-free CDA credit. So let me give you concrete examples using numbers from actual planning scenarios, okay, that you can understand this concept easier. Because it took me a while to understand that. There's a lot of terms, and as a business owner running your business all the time, you don't have the time to think about all that. That's why working with an actual good financial professional team is beneficial for you. So a scenario, okay? Corporate-owned life insurance with $1 million in death benefit to make it easy. Okay, death benefit received by corporation is $1 million. Adjusted cost basis at death is $150,000. The CDA credit created is $850,000, okay? So $1 million minus 150. So the CDA credit created is $850K. So that $850K can be paid to your spouse, your children, or your estate as a completely tax-free capital dividend. The remaining 150, well, that's the ACB portion. It can still be distributed, but it would be treated as a taxable dividend. But just think about what just happened here. You extracted $1 million from your corporation and 850K of it, so that's 85%, came out completely tax-free. Let me show you again why this is so powerful with a direct comparison. Extracting $1 million from your corporation, there's two paths. Path one, traditional dividends, right? No insurance. So if you try to extract $1 million from your corporation as regular dividends, okay, you're in for a ride, okay? Dividend tax at approximately 47%. These are non-eligible dividends. That's $470,000. So your net that you pay in taxes, right? So net to family is $530 out of the full $1 million. Path two, corporate life insurance with capital dividend account. Okay, your death benefit is $1 million. ACB at death is 150K. So tax-free capital dividend account distribution, 850K. So the taxable dividend on the remaining 150 at 47%, it's about $70,000 in tax. So on the full $1 million, you just pay $70,000 in tax. So the net distribution to your family becomes $930,000. The difference is your family keeps an extra $400K from option one and option two. That's on a $1 million extraction. Scale this up to $2 million, $3 million, $5 million death benefits, and you're talking about generational wealth that stays with your family instead of going to the CRA. So hopefully that hits home and makes you understand why the wealthy stays wealthy and why, if you don't know about these strategies, well, you're just doomed, okay? So now here's another layer most business owners miss. When your corporation pays life insurance premiums, it's using dollars that have already been taxed at the small business rate, approximately 12 to 15%, depending on your province. When you pay premiums personally, you're using dollars taxed at your personal marginal rate, which could be 45 to 54%, depending on your province and your income level. So let me show you what that actually means again. So let's do a premium efficiency comparison. $10,000 in annual premiums, okay? Personal ownership, so your marginal tax rate, let's say it's 50%. So your pre-tax income needed is about $20,000. You need to earn $20,000 to have $10,000 after tax. Now, with corporate ownership, with the small business rate at 12%, the corporate tax rate is 12%. So pre-tax income needed is $11,364. That means that the corporation just needs $11,364 to have $10,000 after tax. That's approximately 35 to 40% more buying power when you use corporate dollars, okay? So the exact same premium, the exact same coverage, but it costs you significantly less when paid with low tax corporate dollars versus high tax personal dollars. This is directly from your source document. So corporations pay life insurance premiums with after-tax corporate dollars taxed at the small business rate of 12 to 15% versus personal dollars taxed at 45 to 54%. This creates approximately 35 to 40% more buying power for the same premium. And there's more. The cash value inside a permanent life insurance policy grows completely tax sheltered. So under Section 148 of the Income Tax Act, policies that qualify as exempt and insurers design them to be exempt automatically have their cash value growth sheltered from annual taxation. So compare this to traditional corporate investments, okay? You've got interest income in corporation taxed at approximately 50%. You got capital gains taxed at passive rates. You got dividends subject to Part 4 tax and the RDTOH complications. And then you got life insurance cash value growth, which is 0% annual taxation. So over 20 or 30 years, that tax drag on regular corporate investment compounds, and you're losing approximately half your growth to taxes every single year. So with properly structured life insurance, that growth compounds tax-free. Okay, so this brings me to something critical for Canadian business owners: the passive income rules. Since 2019, if your corporation earns more than $50,000 per year in passive investment income, you start losing access to the small business deduction, right? Or the SBD, like they like to call it. So the small business deductions gets reduced by $5 for every dollar of passive income above $50,000. So at $150,000 of passive income, you lose the small business deduction entirely. So that means that your active business income, the first $500K, that should be taxed at 12%, now gets taxed at the general rate of approximately 26%. So here's what most business owners don't realize with this. Life insurance cash value growth does not count as passive income. So it doesn't trigger the $50,000 threshold. It doesn't affect your small business deduction. So this is, again, directly from the Income Tax Act. Exempt life insurance policies are specifically excluded from the passive income calculation. So if you have retained earnings sitting in your corporation and you're worried about passive income rules destroying your small business deduction, well, corporate-owned life insurance offers a way to grow that money without triggering passive income complications. Now, I need to be very clear about critical compliance point. So this is where some people get into trouble, and any advisor worth working with will know this. Under Section 15(1) of the Income Tax Act, the shareholder benefit rules, if your corporation pays life insurance premiums, but you personally are the beneficiary, CRA will treat those premiums as a taxable shareholder benefit to you. So you'll have to include the premium amount in your personal taxable income. The corporation cannot deduct it. So you get the worst of both worlds. So here's what the current structure looks like. Corporation is both the owner and the beneficiary of the policy. When the insured dies, the death benefit is paid to the corporation, not to you personally. The corporation then has the CDA, the capital dividend account, credit and the corporation can distribute it to shareholders tax-free. This is the proper structure, and any professional recommending these strategies absolutely must know this. So, one more important consideration, and that's the lifetime and capital gains exemption. Okay, so if you're planning to sell your business and claim the lifetime capital gains exemption, which is over $1 million for qualified small business corporation shares, you need to know that life insurance cash value can affect your eligibility. So for shares to qualify for the LCGE, right, the lifetime capital gains exemption, 90% of the corporation's asset must be used in active business. Life insurance cash value is not considered an active business asset. So as an example, let's say you've got corporation assets of $5 million. Then your life insurance cash value, let's say it's $1 million. So that's 20% of assets. So that means that you may not qualify for the lifetime capital gains exemption. So here are solutions for that. First, you hold life insurance in a holding company. So that's separate from your operating company. 2, time policy purchases around your planned business sale. And then 3, make sure you work with professionals to structure appropriately, obviously. This doesn't mean you cannot use these strategies if you plan to sell. It means you need to structure things correctly, often through an holdco and an opco, right? Holding company and operating company. So let me summarize the whole CDA advantage, right? The capital dividend account advantage. 1, you've got premium efficiency. So you pay premiums with low tax corporate dollars, 12 to 15%, instead of high tax personal dollars, 45 to 54%. 2, tax sheltered growth. Cash value grows without annual taxation and doesn't trigger passive income rules. 3, tax-free death benefit. So death benefit creates CDA credit for tax-free distribution to shareholders. And 4, it's an estate multiplier. So you turned retained earnings into multiples of tax-free estate value. This is why I call the CDA the most powerful tax planning tool available to incorporated Canadian business owners. So when you combine corporate-owned life insurance with capital dividend account, you create mechanism for transferring generational wealth tax-free. So now that you hopefully understand a bit more how the CDA works, let me show you the other strategies in the playbook of the wealthy that is available to any small business owners in Canada, including how to create tax-free retirement income while you're still alive. So, the CDA is incredibly powerful for transferring wealth to the next generation. What about while you're still alive, okay? What about creating retirement income? What about maximizing deductions today? Let me show you 3 major strategies that sophisticated Canadian business owners use, and I'll explain how each one works, who it's best for, and the specific Income Tax Act sections involved. So strategy 1 is called individual pension plans, or IPPs, right? So first question, what is an IPP? An individual pension plan is a defined benefit pension plan registered under Section 147.1 of the Income Tax Act in Canada. It's designed for a single individual or small group of key executives, typically owner-managers of incorporated businesses. Most business owners know about RRSPs, right? In 2024, the maximum RRSP contribution is approximately $31,500, right? Or 18% of your previous year's earned income, whichever is less. So for a business owner earning $300K, $400K, or $500K, that RRSP limit feels frustratingly small. So here's where IPPs become powerful. Unlike an RRSP, which limits how much you can put in, an IPP is based on what you can get out in retirement, okay? That's the massive difference. So contributions are calculated actuarially, meaning an enrolled actuary determines how much needs to be contributed today to fund specific guaranteed retirement benefit. So for business owners over 50 with consistent T4 income history, IPP contributions can potentially range from $50K to over $150,000 a year, significantly more than RRSP limits allow. So here's the mechanics on how IPPs work. So number 1, your corporation establishes an IPP with you as the plan member. 2, an enrolled actuary calculates required annual contributions based on your age, years of service, and income history. 3, your corporation makes 100% tax-deductible contributions to the IPP. 4, your funds grow tax-deferred inside the plan. And 5, at retirement, you receive a guaranteed pension income for life. So the tax treatment on that is that the employer contributions, that's 100% tax-deductible to the corporation. In terms of growth, that's tax deferred inside the plan. Retirement income, that's taxed as pension income, but qualifies for pension income splitting with a spouse after age 65. So let me give you an example from actual planning scenarios, okay? So let's say an age 50 business owner, $500,000 income a year, contributing $75,000 a year for 10 years. So total contributions will be $750K. That's 100% tax deductible. Tax savings at 26.5% general rate, well, that's $198,750 over 10 years. The net corporate cost was $551,250. The projected pension fund at age 60 is $970,000. Death benefit, so if life insurance is included, will be about $1.5 to $2 million. That's guaranteed lifetime pension at $65,000 to $75,000 a year. And here are the key advantages, okay? So contributions up to about 33% can be allocated to life insurance within the individual pension plan. So pension splitting saves an additional 8 to 12K per year in taxes in retirement. Then you've got a strong creditor protection, which is a registered pension, okay? Now, who are the IPPs for? So IPPs are annual for older business owners age 40 or older, but especially powerful for those that are 50 plus. So those that are closer to retirement. Those with consistent T4 salary income of $150,000 or more for at least 3 years, and corporations with stable cash flow that can commit to mandatory annual contributions, those who want guaranteed lifetime pension income, and those who have already maximized RRSP contribution. So there is important limitation to know about. So IPP contributions are mandatory each year based on actuarial calculations. So if your business has highly variable cash flow and you might need to skip contributions in bad years, an IPP could create problems for you. Also, and this is critical, if you only take dividends from your corporation, so no salaries, you won't have the T4 income history needed for significant IPP contribution room. Now to strategy number 2, which is corporate-owned life insurance paired with insured retirement plan. And this is where it gets interesting, okay? So we've already discussed about how corporate-owned life insurance creates tax-free wealth transfers through the CDA. But there's another strategy, the insured retirement plan, that creates tax-free retirement income while you're still alive. So here's how the IRP concept works, okay? Here's how it works. Number 1, your corporation purchases a permanent life insurance policy with strong cash value accumulation, okay? 2, over 10 to 20 years, cash value builds itself inside the policy, completely tax sheltered. 3, in retirement, instead of withdrawing the cash value, which would be taxable, you borrow against it through policy loans. 4, policy loan proceeds are not taxable income. They're loans, not income. 5, the loans don't get reported on your tax return, so they don't trigger clawbacks. 6, interest on the loans capitalizes, so you don't make payments during your lifetime. And 7, when you pass away, the death benefit repays the loans and the remaining amount goes to your family tax-free via the capital dividend account. So why this is powerful, right? Tax-free versus taxable. So the traditional RRSP or RRIF path, withdrawals are fully taxable as income. At the top marginal rate, there's 45 to 54%. Nearly half your withdrawal goes to tax. Withdrawals count as income for your OAS clawback, and above $87,000 in net income, the OAS starts clawing back. At $152,000 or more, you lose OAS entirely. That's roughly $8,000 a year, okay? While the IRP path, right, with policy loans, your loan proceeds are not taxable, it's borrowed money. You receive the full amount with no tax deducted. Loans don't count as income for OAS purposes, no clawbacks. And death benefit replays loans and remaining amount flows tax-free to your family. Let me walk you through a realistic example from the source documents, okay? Business owner age 45, funds policy with $75,000 a year for 20 years. So accumulation phase, that's ages 45 to 65, okay? Annual premium, that's $75,000 times 20 years, that's $1.5 million. Cash value at 65, that's $2.5 million tax sheltered growth. Death benefit is $7 million, okay? So now retirement phase, age 65 to 90, annual collateral loan, that's $100K a year times 25 years. Total borrowed, that's $2.5 million, so all tax-free. Interest capitalizes at 5%. Total loan balance at death, that's $4.2 million, including interest. So at death, like age 90, the death benefit becomes $7 million, less outstanding loan of $4.2 million, and net tax-free to estate via capital dividend account of $2.8 million, plus already received $2.5 million tax-free during retirement. Total value created, $5.3 million from only $1.5 million invested. Okay, so who's the corporate-owned life insurance with the IRP strategies ideal for? Business owners age 35 to 60, any age works, but earlier is better for cash value accumulation. Those who want tax-free retirement income that doesn't affect the OAS. Those who want maximum flexibility, so the corporate-owned life insurance premiums can often be adjusted or skipped in difficult years. Those who want both retirement income and estate protection. Those concerned about passive income rules, so cash value doesn't count. And those who may not have consistent T4 income history. Corporate-owned life insurance doesn't require it, and any employee count, so no coverage requirements for your employees. Okay, now strategy number 3, which are retirement compensation arrangements, or RCA. Okay, what's an RCA? A retirement compensation arrangement is defined in section 248(1) of the Income Tax Act. Is designed for the ultra high earners, okay, who have already maxed out the RRSP and IPP contribution room and still want to defer significant income into retirement. So here's the key mechanic to understand. When your corporation contributes to a CRA, it must remit 50% of that contribution to CRA as a refundable tax. The CRA holds that 50% and returns it when you start receiving benefits from the CRA in retirement. Example, corporation contributes $300,000 to RCA, remitted to CRA is $150K of that, right? 50% refundable tax. Actually invested in CRA trust, now you're left with $150K. So when you receive distributions in retirement, the CRA refunds the 50%. So why would anyone want to use this? The trade-off is obvious, right? Only half your contribution actually gets invested initially. But for ultra high earners who need to defer $200K, $300K, or $500,000 plus per year, amounts far exceeding RRSP and IPP limits, and RCA is one of the few options available. Who are the RCAs for? So these are for business owners earning $500,000 or more annually, those who have already maxed out their RRSP and IPP contribution room, those who need to defer an extra $200,000 to $500,000 or more per year, corporations with very strong, consistent profitability, and those with sophisticated accountants comfortable with complex structures. Again, very important, at contribution levels below $150,000 to $200K per year, an RCA typically doesn't make sense. The 50% mechanism makes IPP or corporate-owned life insurance more efficient at lower amounts. So now here's what I call the hybrid approach. The most sophisticated business owners often combine those strategies together. Example, the individual pension plan with the corporate-owned life insurance. So for IPP, that's $80,000 a year for maximum tax deduction and guaranteed pension. For corporate-owned life insurance, that's $50,000 a year of contribution for tax-free retirement via the IRP and tax-free death benefit via capital dividend account. The result, you're seeing maximum deductions today through IPP, guaranteed pension income in retirement from IPP, tax-free supplemental income from IPP that doesn't affect your OAS, tax-free legacy to family via your capital dividend account. That gives you the best of both worlds. But here I gotta be completely honest as well. This is obviously very complex, and I'm doing my best to try to explain this in the most simplest way possible. I've given you a 30,000-foot view overview of the strategies that have entire textbooks written about them. Actual implementation involves actuarial calculations and enrolled actuary involvement for IPPs, RCA trust establishment and compliance for RCAs, policy design optimization and carrier selection for your corporate-owned life insurance, coordination with accountants, lawyers, and insurance specialists, annual compliance, CDA tracking, and ACB calculations. So hopefully you understand this is not a do-it-yourself project. This requires working with qualified professionals who understands both the tax side and the insurance side. But now you understand what's possible under Canadian tax law. So in the next chapter, I'm going to explain the concept that underlies all of this, okay? The fundamental difference between tax deferred and tax-free. All right, so I need to explain something that most people gloss over, and it might be the single most important concept in this entire video. The difference between tax deferred and tax-free. Most people think that these are basically the same thing. They hear tax benefit and assume they're getting a deal. But these two concepts are fundamentally different, and confusing them could cost you hundreds of thousands of dollars over your lifetime. So when you contribute to an RRSP, you get a tax deduction today. That feels very good. But here's what's actually happening. You're not eliminating taxes, you're just postponing them. So that money is going to grow for 20, 30, maybe 40 years, and every single dollar, including all the growth, will be taxed as ordinary income when you withdraw it. With tax-deferred accounts like RRSPs, you're essentially in a partnership with CRA. They're your silent partner in your retirement account. You cannot see them on your statements, but they own a percentage of everything you've accumulated, and they're definitely going to collect when you start withdrawing that money. Now, consider the alternative, structures that provide tax-free growth and access. So, for example, corporate-owned life insurance with the IRP strategy. 1. You get tax-sheltered growth, so cash value grows without annual taxation. 2. You get tax-free access. Policy loans are not taxable, they're borrowed money. You got no OAS impact. Loans aren't income, so no clawback. 4, you get tax-free transfer. So death benefit flows through a capital dividend account to family tax-free. When structured correctly, money goes in with low tax corporate dollars, so 12 to 15%. Money grows without annual taxation, and money comes out without triggering income tax with loans. So money passes to your heirs without taxes as well, with capital dividend accounts. So if you compare that with an RRSP or RRIF withdrawals, for example, well, you're going to be taxed at full marginal rate, so 45 to 50%. You trigger OAS clawback above $87,000, the required minimum withdrawals starting at 71, and no pension splitting until 65, right? And then with IRP policy loans, well, again, tax-free because it's borrowed money, not income. No OAS clawback, so loans aren't reported income. No required withdrawals, you're completely flexible, and death benefit repays loans and flows tax-free to your family. So here's the framework that I want you to take away with, okay? Ask yourself, do I expect to be in a lower tax bracket in retirement or higher than I am today? Then if the honest answer is probably higher, and for many successful business owners, it probably will be, then you need to seriously evaluate how much of your wealth building is happening in a tax-deferred vehicles versus tax-free vehicles. There's another factor unique to Canadian business owners that makes this even more important. The passive income rules creates a penalty for holding traditional investments inside your corporation. So if you earn more than $50,000 in passive income, you start losing small business deduction. At $150,000 passive income, you lose it entirely. That means that active business income now gets taxed at 26% instead of 12%. And life insurance cash value does not count as passive income. So for Canadian business owners with retained earnings, corporate-owned life insurance offers a way to grow wealth without destroying your small business deduction. Now, let me be completely honest once again about who these strategies are for and who they are not for. So, I'd rather you watch this chapter, realize that these strategies aren't right for you yet, and just move on, than pursue something that just doesn't fit your situation at all. Okay, so let's start with who these strategies that I've all explained in this video are not for. Okay, 1, if your business is just not incorporated, right? That's number 1. These strategies require a Canadian-controlled private corporation, so our CCPC. If you're a sole proprietor or operate through partnerships, you don't have an incorporation, an Inc., the CDA doesn't exist for you, okay? 2, if you're too early stage in your business, so if your business isn't generating consistent, significant income, or you're reinvesting everything back into growth, then the capital commitment these strategies require might not make sense for you yet. Build your business first, then these strategies will still be there and you'll be able to use it. 3, people who need maximum liquidity. These strategies involve committing capital over extended periods. If you might need access to every dollar in the next 2 to 3 years, long-term structures aren't appropriate. 4, business owners with highly variable income. IPPs require mandatory annual contributions. If your income swings dramatically and you might not be able to fund contributions in bad years, an IPP could create problems for you. However, corporate-owned life insurance offers more flexibility and premiums can often be adjusted or skipped. 5, if you're looking to sell your business within the next 2 to 3 years. If you're planning to sell your corporation or your operating company very soon and claim the lifetime capital gains exception, corporate-owned life insurance in that operating company can complicate eligibility. This doesn't mean you can't use these strategies, it just means you need to have proper structuring through a holding company. And now who these strategies may be for, right? So 1, incorporate business owners with consistent profitability. So if you're a CCPC or your Inc. has been generating stable, significant profits for several years, you have the strong foundation. 2, business owners paying substantial taxes already. If you're writing meaningful checks to the CRA at both corporate and personal levels, these strategies deserve exploration. 3, business owners age 40 plus wanting to accelerate retirement. IPPs become increasingly powerful with age. A 50-year-old with consistent T4 income can contribute significantly more than a 40-year-old. 4, those who want tax-free retirement income. So if you expect to remain in high tax brackets in retirement and want income that doesn't trigger the OAS clawback, the IRP strategy is worth considering. And 5, those who want tax-free legacy. If transferring wealth to the next generation tax efficiently matters to you, the capital dividend account strategy is incredibly powerful. And 6, those concerned about passive income rules. So if you have significant retained earnings and worry about passive income eroding your small business deduction, corporate-owned life insurance offers a great solution. So here's a quick self-assessment you can do. Is your business incorporated as a CCPC? If the answer is yes, then keep going. Has your business been consistently profitable for the last 3 years? Are you paying significant taxes you'd like to optimize? Do you have $25,000 plus annually available for long-term planning? Are you comfortable with a 10+ year time horizon? And are you willing to work with specialized professionals? If the answer is yes to most of these, then it's probably worth exploring further these strategies mentioned in this video. So finally, in the final chapter, I'll tell you exactly what you can do with this information now. All right, so now you understand the landscape. What do you actually do with this information, okay? So step 1, please don't fire your CPA. Don't fire your accountant. Your CPA is still very essential. They handle tax compliance, corporate filings, and day-to-day tax advice. These strategies supplement what your accountant does. They don't replace it. So the best implementations happen when your accountant is actually involved and bought in from the beginning with those strategies. Step 2, understanding the gap, okay? So remember, your accountant knows taxes, but likely can't implement insurance-based strategies. And most insurance agents and financial advisors know insurance, but may not understand corporate tax planning. So you need professionals who operate in both worlds or who work together as a team. Step 3, evaluate your situation. Based on what I've shared in this video, again, is your business incorporated as a CCPC? Are you generating consistent, significant income? Are you paying substantial taxes already? Do you have capital to commit over multiple years? And are you willing to work with specialized professionals? If yes to most of these questions, then it's worth exploring. Step 4, you gotta find the right professionals. So look for advisors or professionals who have an understanding of corporate tax strategy and the Income Tax Act. They have insurance licensing and expertise in corporate-owned life insurance. They have experience implementing IPPs, RCAs, and corporate insurance strategies. They have the ability to coordinate with your existing CPA, and they have access to enrolled actuaries for IPPs. So a couple warning signs for you. Anyone who says that these strategies work for everyone, anyone who recommends implementation without involving your accountant, or pressures you to decide quickly, reluctance to show you Income Tax Act references, then that's your sign that you gotta run the exact other way, okay? Step 5, run your numbers. Before committing to anything, see your specific numbers. Any good professional you meet up with should be able to show you your numbers. So policy illustrations from multiple carriers for your corporate-owned life insurance, actual calculations for IPPs, cash flow projections, tax impact analysis, your capital dividend account, credit calculations, comparison to your current approach. So if you gotta get super clear on what your current situation is. Step 6, get your team aligned. The best implementation involves your CPA for tax integration and compliance, a specialized insurance advisor or financial advisor for policy design, potentially even a tax lawyer for complex structures, an enrolled actuary if implementing an IPP. So these professionals should communicate with each other. And sometimes it's better to find a firm that already has all of those so that you don't have to meet with everybody separately and repeat the same old story all the time. So the bottom line is you've just learned more about tax advantage wealth strategies for Canadian business owners in the last hour than most business owners learn in their entire careers. And this is the video that I wish I had when I started 5 years ago. When I started my business, I wish someone had explained this to me in that exact language. It would have changed everything and would have saved me hundreds, if not millions of dollars already paid to the CRA. So what you do with this knowledge now is completely up to you. You can file it away and keep doing what you've been doing, or you can explore whether these strategies might help you build wealth more efficiently. Either way, you're now making an informed decision instead of operating in the dark. So if you made it this far, thank you, okay? I know I threw a lot at you. The CDA, IPPs, RCAs, RRPs, passive income rules, the lifetime capital gains exception considerations. It's a lot to absorb, and I know it. And that's why I've put together a companion resource that summarizes everything in this video with a self-assessment checklist, some questions you can ask your CPA, your accounting, your financial team, okay? It's a completely PDF workbook that you can download. The link is in the description below. Completely free. I'm not even going to ask for your name, your email, phone number, none of that. Just completely for free. So if you found value in this video, just download that resource. And it's the best way to make sure you can actually use what you learn and kind of repeat it so that you can understand the situations and what's available for you. Okay. So if this was helpful, please hit the like button and subscribe. We put a lot of effort and time into creating these videos. And I want to create more of that educate the younger me when I started in business, so that we can go deeper into strategies that Canadian business owners need to understand. In the comments, I'd love to know, what was your biggest takeaway? What's still blurred, right? Was there something that surprised you from all the strategies available to you? I read every comment and I personally respond to them myself. So it would mean the world if you can just share me your thoughts and let me know what you thought. So 5 years ago, I started a business in Canada, completely lost about taxes. I was doing what everyone told me to do, incorporating, maxing out my RSP, taking a salary, and watching massive chunks of my hard work disappear to the Canadian Revenue Agency. Nobody told me about the capital dividend account. Nobody explained the licensing gap. Nobody showed me what was possible. So I made this video so you don't have to figure this out the hard way like I did and already too late. These strategies exist. They're in the Income Tax Act for decades. They're CRA approved. They've been used by sophisticated business owners for decades. The only question is whether you'll use them too. Thanks for watching, and I'll see you in the next one.